sharing, okay?
Okay, thank you.
Before we begin, I do have to show you both the short version as well as the longer and more detailed. Basically say that because CME Group is an exchange operator and not a broker-dealer, we are unable to offer you any kind of financial or investment advice. So with that in mind, as we know, the global economy has been through this tremendous shock, and it's not really back to normal. There are places that are starting to return to normal, like the United States, for example, by the end of the second quarter, probably had come back to where it was before in terms of gross domestic product. But that's not true, for example, in the US labor market, where there's still about 7 million fewer people working now than there were before the pandemic. In Europe, Japan, and the United Kingdom, economic activity remains below where it was at the beginning of the pandemic. That's true for most countries, with the exception of a few places like China that have managed to grow because they have very strong manufacturing bases. But the policymakers around the world have come up with a variety of responses to the pandemic that have had a very big impact on certain metals prices, particularly on silver and copper, but to some extent also on gold. So the first thing, policy fiscal response, by which I mean spending a great deal of money to offset the damage that the pandemic has done to the global economy. This is particularly true in developed countries like the countries of Western Europe, for example, the United States, where the government has spent a tremendous amount of money, often upwards of 15% of gross domestic product, in order to boost economic output and to offset the negative impacts of the pandemic. It's also true in some emerging markets as well, particularly in Portugal's former colony, Brazil, where the government has spent a great deal of money, and some other emerging markets like Thailand, Chile, and Poland. But generally speaking, emerging market countries have spent less money dealing with the pandemic than have developed like those in Western Europe, Japan, or the US. And I think the reason for that is fairly simple. The reason for it is that in emerging markets, the central banks can still cut interest rates because most of them have interest rates that were above zero. So many emerging markets provided a great deal of monetary support through lower interest rates, but that wasn't really the case, for example, in Europe or Japan, because in Europe and Japan, interest rates already were zero at the beginning of the pandemic. And in the United States, they weren't too far above zero. They were a little bit below 2% when the pandemic began. So there was not a lot of scope to cut interest rates any further. So as a result, in the developed countries, the main response was to expand budget deficits and to spend a great deal of money. But the rich countries have also done one other: short-term interest rates that much, or in some cases, like in Europe and Japan, they couldn't cut short-term rates at all. They have been expanding the balance sheets of their central banks. So you've seen a really tremendous balance sheet expansion, especially in Japan and in Western Europe, with the ECB continuing to expand its balance sheet. The Bank of England and the Federal Reserve in the United States have done some balance sheet expansion, but their QE programs are not as big as what we saw in Europe or Japan. And then some other countries like Canada have also done their first ever quantitative easing programs. What they did in the US was that the Federal Reserve created about $3 trillion of liquidity in 3 months last year, in March, April, and May. Then subsequently, they slowed the buying program down a great deal. So the Fed is now buying, I think, about 125 billion per month or so, which translates to about 1.5 trillion per year. And that in turn comes to around 7% of gross domestic product. So the various markets have shown a very strong response to this, but the two strongest response have been mainly technology stocks, like you see in a NASDAQ 100, and metals that have some industrial uses like silver, as well as copper. Gold, on the other hand, has not shown as strong a response. Gold prices are higher now than where they began the pandemic, but they're only about 20% higher. And even at their best levels, they were only about 35% higher. So gold has been an underperformer in this environment. So we'll talk about why that has been the case, and what might happen to gold in the future. But before we do that, though, I think there's a few really important things to understand about the state of the economy. The pandemic has been very disruptive to the global service industry, in particular to industries that involve creating experiences like travel, such as hotels and airlines. The way in which it's impacted consumers is they've been spending a lot less money on experiences, so they've been spending more money on things like retail sales, meaning industrial goods for manufactured items, as well as home improvements. So people have been spending a lot of money on housing, a lot of money on manufactured goods because they have not been able to spend money elsewhere. And this has had substantial implications for gold, in particular, because gold is typically not really used very much in manufactured products. It is true that gold is used a small amount. For example, there are tiny amounts of gold in your iPhone or your Huawei or Samsung phone. But generally speaking, gold is not used very much in manufacturing processes, at least not compared to other metals like aluminum or copper or iron ore, or even silver, platinum, and palladium. The other thing that's happened that I think is really interesting and very different is that household savings rates have increased a great deal, as has household wealth. Before the pandemic began, households in the United States were saving about 7% of their income every year. Since the pandemic began, they've been saving on average around 20%. So people have been spending more money on manufactured goods, less money on experiences, but they've also been saving a lot more money too. Another really big difference that I think has really profound implications for all markets, including for gold, is that we have an increase in household wealth. During the global financial crisis, household wealth plummeted by about 20%. It's that made for a very slow economic recovery during the 2010s. This time, household wealth has increased by about 15% since the beginning of the pandemic. And so this has made households feel very, very wealthy, at least ones that already had assets, because the housing market has gone up, real estate prices have gone up, equities, the stock market has gone higher, bond markets have gone higher, everything has done quite well so far during the pandemic, especially corporate bonds and stocks. So households are feeling very, very wealthy. Another thing that is, I think, worth noting is that inflation rates in the United States have also gone a great deal higher. We're now seeing the highest inflation rate, including food and energy, since 2008. If you exclude food and energy, we're actually at the highest inflation rate since about 1991 or 1992. And so all of this has changed people's expectations regarding monetary policy. For a long time, when the pandemic began, investors thought that maybe the Federal Reserve would actually have to cut rates to zero. Interest rates have been blocked at about a quarter, around 1/8%, but people thought that maybe the Fed would cut rates to zero. But because of the incredibly strong demand for retail sales, rising inflation, strong housing demand, high savings rates, et cetera, the markets now expect that the Federal Reserve is going to start raising rates, probably in a little bit over 12 months' time. Between 12 and 24 months from now, the Federal Reserve will probably increase rates by at least one time and maybe two times. That's the market's current expectation. That can always change. It has not, however, fed through into longer-term interest rates. The longer-term interest rates in the United States have actually been pretty stable. basically where they were before the pandemic, and they've actually been falling in recent months after a big rise during the first quarter. So all of this has really big implications for gold because gold, first of all, has a negative correlation typically with the US dollar. If the US dollar rises versus other currencies like the euro and the yen, typically gold prices fall along with the euro, the yen, and other currencies. Likewise, if the Federal Reserve begins to increase interest rates, or especially if the market expects the Federal Reserve will increase interest rates in the future, that's often negative for gold and silver prices, but especially for gold. Gold historically has had a somewhat unstable, but nevertheless quite negative relationships with the Fed funds future price 2 years forward. And so you can see that there is a strong negative relationship between those two. When the Federal Reserve began cutting interest rates in 2018 and continued to cut them until the beginning of the pandemic in early 2020, the price of gold went a great deal higher. It went from $1,200 to about $2,000 an ounce. But as the Federal Reserve has subsequently been expected to start raising interest rates over the next 2 years, the price of gold has not really followed through on that rally, and instead is corrected. It is now trading around $1,800 per ounce. I think it's also useful sometimes to compare gold to silver. We saw earlier that silver has benefited a lot more than gold has during the pandemic. So let's take a look at why that is. First of all, gold and silver tend to have a very strong positive correlation. They have typically a correlation of around 0.8 or 0.9, depending on the period. But the gold-silver ratio, however, is not very stable. When the pandemic began early last year, gold was at a record high versus silver. 1 ounce of gold could buy over 120 ounces of silver. Right now, 1 ounce of gold buys only about 70 ounces of silver. So it's a really tremendous move downward for gold and upward for silver on their relative exchange rate. And part of that, I think, has to do with mining supply. Silver mining supply has been falling further than gold has. Gold mining supply began to decline a few years ago. Mining supplies peaked out around 2017 and it's been declining for about 3 or 4 years now, but they've only fallen about 2 or 3%. By contrast, silver mining supply peaked out more like 5 or 6 years ago, and it's fallen more like 8 or 9%. So silver mining supply has fallen roughly 3 times as much as gold. Secondly, as we mentioned a few minutes ago, gold is almost purely a precious metal. So when you look at its fabrication demand, most of its fabrication demand involves jewelry, which is sold primarily in emerging markets like India and Thailand and China, as well as jewelry is sold in developed markets. It does have a few other uses. It is used a little bit in electronics, but the electronic use of gold is always below 10% of total global gold production. And of course, it has a few other uses, such as dental uses. It can wind up in people's teeth, as I know from personal experience. And it can also be used in industrial capacities. By contrast, silver, even though we consider it to be a precious metal because it's relatively expensive compared to, say, copper or aluminum, it is in many respects an industrial metal. Of course, it is used for jewelry and for silverware, but that's not its primary use. Its primary use is in actual sort of industrial, quasi-industrial uses, such as electronics and batteries, solar panels, and other uses. Now, there's also one important use for silver that I think is worth mentioning, which is photography. Photography is, of course, as you know, not so important today. Most of us take photographs with our smartphones rather than with old-fashioned cameras that we had developed at film studios. But it used to be that, say, 20 years ago, silver's main source of demand was photography. And so with digitalization, that went away. And I think that helps to explain if you go back a couple of charts, why silver did so badly versus gold over much of the last decade. So between, say, 1998 and 2020, silver underperformed in part because photography died. But the good news for silver is you can only die one time. So photography is dead. It's probably not coming back. We live in a permanently digital world now, but that's already factored into the price of silver. So in photography probably can't shrink very much further. And that's probably also helped silver to rebound during the past year. Now, I think the supply side of silver and gold is more important than people realize. When the price of gold and silver increases, you tend to see an increase in secondary production, meaning that there's a lot more recycling of silver. But when gold and silver prices increase, you tend to see some decrease in dental uses, some decrease in jewelry, especially in both emerging markets and developed markets. You also tend to see an increase in private demand. So I think investors tend to follow the trend in gold. When gold prices are going higher, investors in ETFs, so like exchange traded funds or other commingled investment funds, tend to follow what the price of gold is doing, which may explain why it sometimes has strong trends in its price performance. The other thing to mention, though, is the mining supply is very, very important. So I'll go back a couple of slides here. This is the mining supply chart. I think when we look at gold, we tend to follow on demand drivers a great deal, including those Federal Reserve interest rates and the strength or weakness of the US dollar. But it's easy to overlook supply. And so basically when the price of gold supply goes down by, say, 1%, we would expect on average maybe a 2% rise in the price of gold and maybe a 3% rise in the price of silver. Likewise, if silver mining supply declines, we might expect about a 1.5% or 1.8% rise in each of the price of gold and silver. So I view gold and silver as being very much part of the same ecosystem. The two metals are very closely related to one another. They are connected through the jewelry market and through the investment market primarily. Basically, gold is the bigger and more important of the two commodities. So I view gold as sort of like a planet, and silver is sort of like a very large moon. And together they have a sort of common center of gravity, which explains, first of all, why the prices are so highly correlated with one another. But secondly, why they're sensitive to one another's mining supply. So, we can also think about gold and silver, or gold rather, in terms of the US stock market. I think that many people who invest in gold tend to view it relative to other assets, like should I invest in gold or should I invest in real estate, or should I invest in gold or should I invest in the stock market? And the answer to that question, I think really depends on what's happening economically. If you look over a very long period of time, going back to 1928, which of course is a full 93 years ago, almost 100 years ago, gold and stocks have actually done about as well. They've achieved a similar investment return. Stocks have done a little bit better, but not a tremendous amount. Normally, when we think of the stock market, we think of the stock market in US dollar terms or in euro terms. For example, if you sell your stocks in Lisbon and get euros, or if you sell your stocks in the United States and you get US dollars. But you could also redenominate the stock market out of dollars or euros and denominate it back into gold. And when you do that, what you see is incredibly strong trends that often take place over decades. So for example, between 1929 and 1942, the stock market fell about 80% versus gold. So during that 13-year period of time, you would have been about 1,000% better off if you were in gold rather than in stocks. Then between 1942 and 1965, the opposite happened. The stock market increased a tremendous amount versus gold, rising by about 1,800% over the course of about 24 years or so, until about 1966. Then from 1966 to 1980, this all reversed. The price of gold, of course, went from $35 per ounce all the way up to around $800 per ounce at a time when the stock market was not doing very well. And so you would have been, the stock market declined by about 90% versus gold. So you again would have been about 1,000% or 10 times better off investing in gold rather than investing in the US equity market during that period of time. Then between 1980 and 2000, the stock market outperformed tremendously. It rose 2,400%. And I think that really had to do with the United States and Europe making a decision to kill inflation through very, very high interest rates. And killing inflation in high interest rates, of course, made gold less attractive. We saw earlier that gold tends to have a negative correlation with currencies. The reason for that, I think, is pretty simple. When interest rates on currencies are going higher, that makes gold relatively less attractive. When interest rates on currencies are falling, that makes gold relatively more attractive. Then between 2000 and 2011, the price of gold increased tremendously versus the stock market. The stock market, of course, had a very bad performance during this time with the tech wreck and later on the global financial crisis. Meanwhile, the price of gold went from $280 an ounce to about $1,900. So, again, the stock market fell about 90% in gold terms. Since 2011, the US stock market has been outperforming gold. And it's now is still in this corrective pattern perhaps. But I think the question that we all have to ask is in, say, the next 10 years, does the price of gold outperform stocks? And I think that there are strong reasons why that might be the case. I think that there are very strong reasons why gold might outperform. If you look, for example, between 1966 and 1980, you can see that gold, the first stocks dropped versus gold, then they rebounded, then they dropped again. If you look since 2011, they've dropped, then they rebounded. I wonder if perhaps they are about to decline again. Part of the reason for that is that the stock market is at absurd levels of valuation that really make no sense at all on the basis of corporate earnings. Corporate earnings are basically the same now as they were 4 or 5 years ago, and yet the stock market has risen nearly 100%. If you divide the stock market by the gross domestic product, you can see that the equity market's valuation in the United States is close to a record high. It's around 170% of gross domestic product. And to my mind, there is really one and only one reason why that's the case. And that's because long-term interest rates are at very, very low levels. Long-term interest rates being at low levels have caused asset prices of all sorts to go higher. But I think that now what's going to happen is that central banks have found themselves in a trap. They have created a gigantic real estate bubble and a gigantic bubble in equity markets. And so if they begin to tighten policy and as a result of strong economic growth and as a result of higher inflation, they're likely to push interest rates higher, which could cause the stock market to crash. That in turn could force central banks to ease policy once again. So the central banks are caught in a sort of a trap of asset bubbles. And that might wind up being bullish for the price of gold. If you look at options on gold and silver, investors are clearly very, very nervous about gold and silver. They think that there's a lot of potential volatility. The volatility in gold and silver options are very, very high now compared to where they were before the pandemic. So people, even though gold and silver prices are higher, they see a great deal of uncertainty as to where they are headed. I mentioned briefly that gold and copper also have an interesting ratio that also can move tremendously. At the beginning of the pandemic, 1 ounce of gold bought over 7 pounds of copper. Now it buys only about 4 pounds. So copper has really tremendously outperformed gold. I think a lot of that has to do with the fact that the Chinese economy is so tremendously strong right now. We're seeing extremely high rates of economic growth in China. It came out of the pandemic relatively well. And also, China has a very strong manufacturing base. So as people around the world can't spend money on experiences anymore, they can, however, spend money on manufactured goods, many of which are made in China. But higher demand for manufactured goods tends to be good for things like aluminum and copper, agricultural goods like wheat and soy, for other industrial metals like steel and iron ore, and even for oil. But it does not, however, tend to be a very good thing for gold. So we think this is one of the major reasons why gold prices have underperformed during the last year, is that they don't draw any benefit from stronger growth in China, whereas most other economies do. So of course, this makes it very important what happens in China. Just very briefly, the price of copper tends to follow an alternative measure of China's economic progress called the Li Ka-Chang Index. The Li Ka-Chang Index is, I think, a very useful index for anybody who wants to understand commodity markets. It includes only 3 components. It includes rail freight volumes, electrical consumption, and bank loans. And it tends to be very highly correlated with commodities. But what's happening in China is interesting. First of all, China's economy grew in the last year, I think, for 3 major reasons. First, as we mentioned, very strong demand for manufactured goods. So that's been good for China. Secondly, China was able to reopen its domestic economy because they controlled COVID relatively well. And third, China took on a great deal of additional debt. China's debt ratios have been soaring in the last year, and that has been giving a great deal of economic stimulus to the Chinese economy. But there are problems with this outlook. So first of all, China is now trying to stabilize its debt levels. The Chinese government is afraid that debt levels are too high and they don't want any more leverage. So they're pulling back on fiscal stimulus. That could be good for gold, but it's going to likely be bad for silver and copper. So the rally in silver and copper that we've seen relative to gold prices might not last. Secondly, China, even though it got the pandemic under control domestically, is now faced with a strange situation. First of all, its vaccine, the Sinovac vaccine, doesn't seem to work very well. Its effectiveness is probably only around 50% compared to maybe 70% or more for AstraZeneca and Johnson & Johnson, and maybe 90% or more for Pfizer and Moderna. Secondly, the Chinese population is not very enthusiastic about getting the vaccine. So China is a little bit behind on its vaccine program compared to the United States, the United Kingdom, and even compared to Western Europe. So even though China got its domestic problem under control by shutting its borders, it may now be faced with a situation where it has to keep its borders closed more or less forever until the pandemic goes away or until the much, much higher portion of its population has received the vaccine or until a more effective vaccine is being distributed. Thirdly, China also has a very strong currency. And having a very strong currency puts China at a competitive disadvantage with respect to its exports. So to my mind, what might be likely to happen is that China's economy might begin to slow down a great deal. Also, as the global economy reopens and the pandemic ends, consumers can go back to spending money on experiences and maybe less money on manufactured goods. So that would be bad for copper, aluminum, even for silver, but might not necessarily be a bad thing for gold. Gold might actually do well in that sort of environment. Lastly, speaking of experiences, we can compare gold to crude oil. Crude oil, of course, is a driver of experiences. Anytime you travel or go on vacation, you have to use crude oil products in order to move yourself from one place to another. So crude oil has done very, very badly, obviously, as a result of the pandemic. But its price has been going up more recently because people are starting to go back to work. And people are also starting to go back on vacation as things reopen. And OPEC has also done a really good job of supporting the price of oil. So we have seen a recovery of travel and a recovery of demand. Also, crude oil inventories have begun to fall as well. as have the inventories of various oil products. So in a nutshell, our view of gold is that the negative influences on gold prices are likely to be as follows. We think that there's a large group of people going outside of my apartment chanting something, so I'll have to wait for them to go by. I
Don't
hope they'll
worry.
go away in a second.
Don't
But
don't
anyway,
worry.
I think they're passionate supporters of the English soccer team. So we know that, of course, there's this important soccer tournament, or football tournament. So that's what's going on. But so basically, the negative influences on gold, I think, are going to be the strength of the U.S. economy. Now, you may think of gold as an inflation hedge, but the irony is this. If inflation really is rising, what that means is that the US central bank has to tighten monetary policy more quickly. And tighter monetary policy is typically not good for gold. So this may be a case in which the economic strength of the United States economy and the necessity perhaps to increase interest rates is negative for gold rather than positive. On the other hand, on the positive side for gold, you have an overvalued stock market and an overvalued bond market. And the US treasuries are very unattractive. The 30-year bond in the US yields only 2%, and that's much higher than long-term yields are in Europe. Of course, as anybody in Portugal well knows, Portuguese long-term bonds are trading at very low interest rate levels, and even lower interest rate levels are present in Germany and France and other core European countries. So investors just don't have a lot of choice. They can invest in overvalued stocks, overvalued bonds, or maybe they could also invest in precious metals. So I think that also makes for a potentially bright outlook for gold. Lastly, compared to other commodities, I think China's economy may begin to slow down because they've not really been able to inoculate their population or reopen their borders. Consumers may begin to shift spending away from manufactured goods and towards other items. Silver and copper have done very well during the past, say, 15 months. I suspect that they will not do as well in the next 15 months. But if China slows, that might be bad for silver and for copper and other industrial metals, but it is unlikely to be a bad thing for gold. So I think that gold might go higher on that basis. And just one last point to review, which is mining supply. Mining supply has a strong influence on the price of gold. And mining supply of gold and silver has been falling in recent years. The major question is, will the recent period of higher prices increase investment in gold and silver mines? And if so, how long will that take to bring additional production online? But it might take a very long time. Typically after past periods of price increases, it's taken perhaps 7 years or more for those price increases to feed through to higher levels of production for gold and silver. And if that turns out to be the case, that could also be a positive thing for gold and silver. So gold has both downside risks and upside risks, but it seems like maybe the upside risks over the next few years might outweigh the downside risks. So that's my view on gold and what's driving it. And I think now we should have time for questions.
Okay, thank you, Eric, for your presentation. Yes, of course, we could do some questions. Everyone could use the chat line available on the app, and he could use it to ask anything that he wants about the subject. So, any questions via our guests? Okay, I think we have one. Just see about. So we have some questions about the current price and if it is a good buy at this point, considering the inflation or the ghost of inflation.
Yeah, so that's a really good question. So when you look at inflation here, inflation rates have been going a lot higher. We've seen a really strong pickup in inflation in the United States. We haven't seen that so much in other countries. Like you're only seeing a small amount of additional inflation, for example, in Europe, which hasn't given as much stimulus to its economy. During the 1970s, for example, high rates of inflation coincided with a significant rise in the price of gold. But I think it's a mistake to think that that's going to be the case in the future. And the reason is this: with the high rates of inflation in the US, if they persist, what that's likely to cause is it's likely to cause the Federal Reserve to start raising interest rates. And if the Federal Reserve begins to raise interest rates, that could actually be bearish for the price of gold. The Federal Reserve moment insists that it's going to stay on hold and it's going to keep interest rates low for some period of time. But I think the question is, how long of a period of time is that? Given that people have very high savings rates and household wealth is increased, and as the economy continues to reopen, I think people will start shifting spending away from manufactured goods and more towards services. And that will allow the Federal Reserve to begin raising interest rates more quickly than maybe it had thought it would be possible before. And so that might be bad for the price of gold. So the irony is, I actually think higher inflation is not good for gold prices for the simple reason that it will likely cause the central bank to increase interest rates
Okay, thank you for your answer, Eric.
more quickly than it might have otherwise. And you can see that through this sort of negative relationship and the price of gold. Yeah, sorry, can you hear me still? Is that okay?
Yes, we have some cut here. We left hear you about 5 to 7 seconds, I think, but I think everyone could hear your explanation. I think that is it. We have another question that you begin to explain in the previous one. Someone is asking to explain the logic why higher interest rates would make gold less attractive. If you could just go
I think
back.
the logic
Yes.
is that, yeah, sure. So I think that the logic is that gold is a sort of currency. It's a sort of, you could say that gold is maybe the world's oldest consistently used currency. With about 5,000 years history. But what makes gold different than, say, the US dollar is that gold does not pay any interest. It always has an interest rate of 0. And it always has actually a small storage cost because you have to pay somebody to keep your gold safe. So in reality, gold is a little bit more like the euro is at the moment. It has a slight negative interest rate after you take into account the cost of storage of gold. By contrast, the US dollar, even though interest rates are close to 0 at the moment, does not always have 0 interest rates. So if the Federal Reserve begins raising interest rates, what that likely will do is it will make the US dollar relatively more attractive versus a 0 interest rate currency like gold. And the same is true, I think, for currencies in general. And we've already begun to see certain central banks raising interest rates. So we've already seen Mexico, Brazil, and Russia beginning to increase interest rates. More importantly, there are no more central banks anywhere that I'm aware of that are still cutting interest rates. Interest rate cuts are over in the United States, in Europe, in Japan. They're over in Australia and in Canada, and in, I think, most emerging markets, or maybe even all emerging markets. So monetary policy is not getting any easier. It's only going to start getting tighter. And I think central banks may also begin pulling back on quantitative easing. And so as they do that, they're likely to make their fiat currencies more attractive versus gold, because they'll be creating less currency and then raising the payment rate or the deposit rate on those currencies as they begin to tighten interest rate policy.
Thank you about this this response. We have other question, is a question a little more open. Considering this scenario, I don't want to use the word prediction, but any idea where the current gold price could be in about a year?
In about 1 year?
Yeah.
Yeah, I really don't know. I'm actually not allowed to give
Yeah, I
any sort
understand
of
that.
predictions. Yeah,
Yeah, yeah,
yeah, yeah.
yeah.
Well, what I will tell you though, is in my own personal portfolio, I do own gold. It's not necessarily because I think gold prices will go higher in the next 12 months, but rather I own it because I think it's a good diversifier for the portfolio, alongside silver, and other sort of real assets that are a good diversifier for equities and for bonds. And I'm very, very nervous about equity and bond markets because your equity markets in the US anyway are at extreme valuation levels, and those extreme valuation levels are predicated on the idea that interest rates are going to stay low forever. And if that turns out not to be true, it could be very, very upsetting for stock investors. But I don't think it would necessarily be so bad for gold investors.
Okay, thank you for your explanation on this. I don't know if anyone want to put any other question. Okay, we have a question about platinum, and I think that is really interesting. Platinum has retracted about 20% since the year heights. Uh, any explanation for this?
Yeah, I think platinum has been a very troubled metal in a way because its main source of use has been diesel engines. Um, and diesel engines have fallen out of favor as a result of the Volkswagen scandal a few years ago, as well as a result of environmental concerns and concerns about pollution. Um, and so, with the growth of electric vehicles, platinum has found some new demand in the sense that it can be used in batteries, but its use as catalytic converters for diesel engines is not really in very good shape right now. And so I think that explains kind of why it's been underperforming palladium, and most of the other metals over the course of the past few years. I'm not certain exactly what's driven it down in the last few months, however. That I don't really know.
Okay, but the same person asked, it will be expected to recover on this scenario?
Um, yeah, I think that in order to understand whether platinum is going to recover, I think it's important to look at the demand for diesel engines versus the demand for platinum in a sort of a new economy sort of format. So for example, if platinum is being used in electric vehicles and batteries, that could be a good thing for platinum, but I don't know if it would necessarily outweigh um, the amount to which platinum is used in diesel engines. So I think that the whole diesel engine thing has been really, really bad for platinum.
Okay, really thank you. Just two questions and all about the same subject. We have a question about the valuation of gold from 2000 to 2010 and the way that it go up to, I think that they referred from 250 to 190 about that. And if we can argue that the gold price is manipulated by central banks.
So I wouldn't say that it's really manipulated by central banks. No, in fact, I regret now not having put in a specific chart that I might have liked to put in that shows how central banks deal with gold. The central banks, let me see if I can actually bring up that chart. So in order to do it, I'm going to have to close out of
Okay, don't worry.
my
We are
moments. Let me see, I have a whole bunch of Excel spreadsheets here. Yes, good, I have it here. So this is my huge spreadsheet on gold. Can you see this? I have a chart of it right here for, yeah, here we go. Central, let me see.
just a moment. Yeah, we are seeing your Excel.
third sheet, unfortunately. See if I can find it quickly. Yes, this is it, I think. It's called sheet. Come up, can you see it?
Yes, we are official transactions,
Yeah.
central bank net buying. Yeah, we are seeing it.
Yeah. Yeah, and so central banks, what they tend to do with gold, I think central banks are, not to be mean, I hope there's nobody from a central bank on this call. I think they tend to be the dumbest investors on the planet, in the sense that they tend to follow whatever the price of gold is doing. So if you look at the beginning of this chart, in 1979, 1980, they were buying gold at the peak of
We are not hearing you well
the
right now.
market when gold was like $800 an ounce. And then during the 19th decade, selling gold. So they sold gold for the entire gold during the 1990s when okay, let's see, what is this?
Yeah, we are not hearing you well right now.
Can you hear me now? Is it better?
Yeah. Really better.
Yeah,
Thank you.
sorry about that. Yeah, I got too excited. I stood up and started speaking. I was being passionate. I managed to disconnect my headphones.
Don't worry. Don't worry. All good.
Central banks can do that. So so essentially the central banks, they tend to be the worst investors. They were buying at the peak of the market in the late 70s and early 80s. Then they spent the entire decade of the 1990s and early 2000s selling gold, including most famously when the Chancellor of the Exchequer here in London, Gordon Brown, sold a tremendous amount of the UK's gold reserves to Goldman Sachs at $280 an ounce, which was got to be the dumbest trade of the entire 20th century. And then if you look since 2009, central banks have started buying gold again. And so I wouldn't really say that central banks manipulate the price of gold. I don't think manipulate's the right word. I think that what central banks do is they tend to follow the trend in gold prices, and they tend to sell low and buy high, which makes them terrible investors, but it can also create really strong trends in the gold market that investors can take advantage of. So I don't think they're really manipulators. I just think they're terrible investors.
Okay, that is another way to see it. Yeah, I think we have a question off topic saying that what do you think about Bitcoin could be an improved form of gold, considering that is no storage cost, sorry, cheaper to transport, limited supply. If Bitcoin is accepted on banks or balance sheets, it will be the new gold. I don't know if you could hear my question. Eric? Eric, can you hear me?
Yeah, I saw that my audio connection has just been restored. I'm sorry, I heard you're just so excited. I opened a new spreadsheet, and when I did that, it cut out my audio.
Okay, no problem.
Yeah, Bitcoin to my mind is really very, very interesting. It's like an extreme form of gold in the sense that Bitcoin has a perfectly inelastic supply. No matter how high the price of Bitcoin goes or how low it falls, the amount of supply is always exactly the same as it would be otherwise. The supply is determined by an algorithm. And that supply is limited to about 21 million coins, of which about 18.7 million already exist. Now, I'm not sure that it's true that Bitcoin has zero storage cost. People say it does, but the storage of Bitcoin is not always very secure. So you have to put it on cold storage and find a way to do that. So it can actually cost some money. But I think if you want to know where Bitcoin prices are likely to go, there's one really good indicator, and it's available for free to anybody who wants it. So it's on this website that's listed here at the bottom of this chart called blockchaininfo/charts/market price. And they have a ton of other data too, but this is a really interesting one. And essentially, what you see here is that when the transaction cost or cost per transaction begins to rise, you typically see a crash in Bitcoin prices. So cost per transaction rose back in 2010 and Bitcoin prices fell by 93%. We had another spike in trading costs in 2013. That coincided with a subsequent fall of about 83% in Bitcoin prices. Then we had another spike in 2017. That was followed by an 82% drop in Bitcoin prices. And of course, we've had another spike in transaction costs in late 2020 and early 2021. And so far, Bitcoin prices have fallen by about 50% or so from their highs. So I think that Bitcoin has its own sort of peculiar internal dynamics, one of which has to do with its cost per transaction. Another interesting way to look at it to get to know is number of transactions taking place with Bitcoin. So the number of people using Bitcoin is growing more and more slowly over time. And so typically what happens in Bitcoin is that before prices go down, you start seeing the number of transactions falling or going sideways. And before Bitcoin prices go up, you usually start seeing a rising number of people using the currency. So the currency really hasn't had a great deal of additional adoption since about 2016 or so. So that might not be the best sign for it. But there is one final thing to consider, which is the calculations necessary to create a Bitcoin. So at the beginning, when it was very easy to create new Bitcoin, your computer could perform maybe 1 or 10 or 100 calculations to create a new Bitcoin. Right now, if you use your computer to create a new Bitcoin, you have to perform more than, I think that's more than 10 trillion calculations. About 13 trillion calculations are necessary to create one new Bitcoin. So that's creating a very high cost of production, if you will. So if you view Bitcoin as a sort of commodity, usually commodities can't trade below their production costs for a very long period of time. So in Bitcoin's case, the production costs may have to come down if people don't continue to use the currency. And if the currency remains sort of unhealthy because the cost of transaction, whereas I do see Bitcoin as being sort of like a version of gold. If you'll bear with me for a moment, I'm going to open a couple other spreadsheets. When I do this, the audio will cut out for a second.
Okay, don't worry, we wait.
I'll take a look at this thing. This thing is called, let me see, I think that I just have to find the most recent version of this spreadsheet. Yeah, so I think this is the most recent version I have of it. Let me just open this, probably cut out for a second.
Okay.
See, is it gonna open? Yeah, it's opening. Yeah, just give me 1 second, it's opening. It's opening slowly, but it's opening. But you can see gold is sort of a crazy chart. You have to put it in log term, obviously much more recent than gold. But it's it's precisely versus versus gold in recent terms. I have just one last one. I have to find it. I think it's called supply. I can open it for you. Yeah, here we go. This is a chart I really like. So it's going to be once. Hopefully, it's going to open without too much.
Yes.
Will regulators crack down on it or not?
We have some cuts, Eric. Sorry, I'm not hearing you fine.
Okay, let me see here. Let me just But anyway, I'm going to stop sharing my screen.
Okay, it could work.
Yeah, and maybe, yeah, I think I'll just stop sharing. I think I've shown you enough charts and graphs already.
Yeah.
But yeah, basically Bitcoin has a perfectly inelastic supply. Most of the Bitcoin that will ever exist has already been created. And the real question for Bitcoin, I think, is the health of the Bitcoin market. Do the number of people using the currency increase or not? If they don't increase, it's very hard to see how the price continues to go higher. And I think the best short-term indicator is that cost per transaction that I showed you a few minutes ago. Are there any other questions?
Okay, Eric, I think we run to all of them. Really thank you for your explanations with this. We have another question since you
Okay, yeah, here
asked
we go.
this.
Yeah.
We have a question: if Bitcoin doesn't prevail as a payment means, can it be accessible as a store of value when volatility goes down, like gold, like another alternative to gold, like that?
Yeah, I think it's a difficult question to answer. I don't think we really know the answer to that. Yeah, I think that Bitcoin is first of all, it's just never going to succeed as a payment mechanism. It's too volatile. And the only thing you'd really pay for, the only thing you would ever really use Bitcoin for, I think, would probably be other digital currencies. For example, you might exchange Bitcoin into Ether or Bitcoin into Ripple or something, or XRP or something like that, or into Litecoin. But I just can't imagine anybody like, walking into Starbucks and buying a cup of coffee, or walking into an auto dealership and using Bitcoin to buy a car. So it will really never, to my mind, succeed as a payment mechanism because its supply is too limited, its price is too volatile. So I think the only thing it can ever be is a very volatile store of value. Um, and I think that basically in that sense, it is sort of like digital gold. I mean, you probably wouldn't use gold as a means of payment either. So I put Bitcoin and gold in very, very much the same category.
Okay, thank you for your answer again. I think we don't have any further questions. I think we passed them all. So really thank you for this time, Eric. Really thank you for your presentation and all your answers to our questions. I think we see you in our next webinar with CME on the 14th.
That sounds great. I very, very much look forward to it. I'm sorry if I was a little tired today. I just got off a very long overnight flight, but next week we'll be back with even more energy. On
Yeah.
the 14th. Yes. All right. Thank you.
Thank you. Have a good day.
Thank you. Bye.
Bye to all.
Bye.